Third quarter U.S. GDP data came in this morning at 2.6% was the real GDP number. This was higher than the market's initial expectations of 2.4%. And this comes after two consecutive quarters of negative GDP growth. Is the recession over, or are we still entering a recession? And could things get possibly worse from here? This is the theme of our discussion with Steve Hanke. He is a professor of applied economics at Johns Hopkins University, and he is an expert on all things to do with monetary policy, the economy, and inflation. Professor Hanke, welcome back to the show.
Good to be with you, David.
Let's take a look at GDP first. As I've mentioned, 2.6%, a little bit higher than expected, and certainly a large percentage increase from the first quarter and the second quarter. Both quarters earlier this year saw contractions in the economy, and we were technically in a recession after two consecutive quarters of negative GDP decline. But now Q3 is positive, squarely back into positive territory. 2.6% is rather high compared to the previous quarters. What's your read on what's going on with the economy? Are we on track for a recovery already?
Well, no, I think to put the number in perspective, 2.6% obviously is a lot higher than the first quarter was negative 1.6, second quarter was negative 0.6, and now we have a plus 2.6, these preliminary numbers. That's a little higher than the consensus, which was 2.4, but it's quite a bit lower actually than the Atlanta Fed now forecasting. They kind of get ahead of the curve at the Atlanta Fed. Their new number has just been revised up from 2.9 to 3.1 yesterday, 3.1. So that suggests to me that probably this number, they revise these numbers, David, as you know, 2 or 3 times. And I think they'll probably end up revising it up a little bit. So that this 2.6 will, I think, probably be revised up just a little bit. Now, where does that put us in terms of the bigger picture? Number one, for the last year, we essentially haven't had any growth. And forget all this political debate over whether we had a recession because we had negative growth in 2 consecutive quarters. The National Bureau of Economic Research is the one ultimately that defines whether we've had a recession or not. And they do that with about a year lag after the actual event occurs. So they haven't pronounced anything yet. And they're not going to pronounce, in my judgment, that we actually had a recession in the first and second quarter, even though we had negative growth. But the question is, where are we going? And where are we going is determined by where the money supply is going. It's the quantity theory of money. We've been on this on your program many times. The quantity theory of money is a way to determine national income determination, where it's going. And what do we have? We had the money supply being goosed in early 2020. When COVID hit, we had the money supply growing on average about 3 times faster than it should have been growing to hit a 2% inflation target. And as a result, we have a lot of inflation. We have 8.2% as a headline inflation number right now. And if you look at all the underlying core inflation metrics, actually they're going up. So we have still lots of inflation in the system because of that surge in the money supply growth in early 2020 and really throughout the year in 2020 going into 2021. Now, what do we have? The last 7 months, the money supply is actually contracted by 1.1%. The last 7 months. That's almost unprecedented. And that means, of course, you have a big change in the money supply, and then there's a transmission mechanism. There are lags between the thrust in the money supply, whether it's going up or going down, and what happens in the real economy, what happens to asset price, what happens to inflation. So sometime in 2023, we've got a pretty big recession baked in the cake. So these numbers it's a great thing. You can celebrate it today. It's not negative anymore. We had a positive number, a little over the consensus, a little under the Atlanta Now forecast. The whole picture looks like the economy is kind of flat for the last year, but it's going to head south. And we know it's going to head south because the money supply is contracting. And we know it probably will continue to contract because the Fed is not looking at the money supply, and they're engaged in what they call quantitative tightening, where their contribution to the money supply by the Fed is actually contracting itself. So the only thing keeping the money supply even close to level is the contribution made by the commercial banking system. And we don't know how long that's going to last. That's been declining, by the way. It's still positive.
Points.
It's been reducing. So that's the picture. The main thing is not looking in the rear view mirror, but looking forward out of the windshield. And we've have a recession coming. And why do I say that? The money supply has actually contracted over the last 7 months. That's a big deal. No one looks at the money supply. That is the thing you have to look at if you're looking for where national income is going, where the real economic activity as well as inflation is going.
Okay, a couple points there. So first, you came on the show a few months ago, not too long ago, and I think you had said something like 70% was a probability of a recession at that point. Are you still sticking to that view?
Oh, no, I've raised that several times. You've neglected me, Dave. I haven't been on so long.
I haven't. It's the thought that counts, Professor, but I'm happy you revised the number.
I know you've been thinking of me, but that probability, when I was with you, it was 60%. Then I jumped it up to 80%, and now I would say it's somewhere over 90%.
Wow. Okay. So we're certainly heading for a recession despite today's positive GDP reading. Just on the M2 comment that you made. Now, just correct me if I'm misinterpreting this, Professor, but it seems to me that a lot of the problems in our economy today are caused by higher than expected inflation. We'll talk about inflation in a little bit more detail coming up. But, if the M2 money supply is coming down, shouldn't that, in theory, eventually bring down inflation and then erode a lot of the troubles of the economy brought about by inflation? In other words, shouldn't the declining money supply be a good thing for the economy?
Well, bringing the money supply down from an average growth rate that it had been for the last 2.5 years of around 15%, bringing it down to the golden growth rate of about 5% or 6%, that's consistent with a 2% inflation, that's fine. Bringing it, contracting it is not fine.
I see.
Because you still have a lot, remember the old monetary bathtub, you still have a lot of excess money in the bathtub. It will come out as inflation. And now you're going to squeeze things so much with this quantitative tightening and it's already showing up with no growth in the money supply, basically, for 7 months. You are going to have a situation where you have, if I can use the S word, stagflation. We will have a recession, and we will still have this excess money coming out of the inflation overflow into the economy. So inflation will slow down, but we'll still have a lot of inflation. Now, John Greenwood and I, as you know, John and I collaborate in analyzing and using the quantity theory of money to estimate where the inflation's going. And remember, July 2021, we wrote the first and only article it appeared in the Wall Street Journal, where we indicated what inflation would be. We were the only ones who ever put a number on it. Right. We said it would be 6% and maybe as high as 9%. We're talking today, it went up and peaked at 9.1, the headline, and now it's down to 8.2. We think this December, that's only a few months away, by the end of the year-over-year inflation rate will be between 6 and 8%. That's what Greenwood and I think. In 2023, at the end of the year, what will it be? It'll be around 5%. So it is coming down, but do you want a recession along with that inflation? The inflation's baked in the cake. Now, do you want to give us a recession? And the Fed appears to want to do that, but they're not even watching the money supply. So I really don't know what they're doing, how they're calibrating anything. They really have no clue of what they're doing. I think they're excessively tight with this quantitative tightening that they've got underway.
Yes.
And in addition to recession, we could have some real liquidity problems in the market. That's another downside. Yeah. But this is kind of uncharted territory. You get this string of 7 months of no monetary growth, and they have announced and they are engaged since June in quantitative tightening, shrinking the balance sheet. And what's that mean? That means the contribution to the broad money measure M2 by the Federal Reserve is going to be negative. They won't be contributing anything. So the only thing that will be keeping the money supply growing is what the commercial banks are doing. And the commercial banks so far have more or less offset the contraction and the negative contribution by the Fed. But we don't know if that will continue or not.
You know, it's interesting because across the pond, the Bank of England has more or less commenced quantitative easing. To a certain degree. Back in September, they announced that they would begin buying government bonds to alleviate a complete crash of the government bond market in the UK at whatever scale is necessary. At the same time, they're also raising rates. So they're buying bonds while also raising rates. I'm just wondering if the Federal Reserve could also do something similar. In other words, reverse their quantitative tightening program, initiate another round of QE while at the same time maintaining rate hikes. Is that something we could see here?
Well, the poor Bank of England,
yes,
is another operation. It's pretty clear Andrew Bailey, who's the governor of the Bank of England, doesn't know what he's doing. He's not watching the money supply either. He's exactly like Powell. Neither one of them pays any attention to the money supply. And as a result, they've got things in one hell of a mess in the United Kingdom and in the United States. Now, the United Kingdom, by the way, their inflation rate is 10.1%. 10.1%. So they have even a bigger inflation problem than we do. Plus, they have, before I get off the Bank of England and the Federal Reserve, both of them have not been able to anticipate the inflation that they have caused, and they look like both of them are going to drive their respective economies into recession. So you've got stagflation. I would say that, in the military, if you screw up and miss a target, you end up with what's called an after-action report. Now, the after-action report tries to find out, why did they screw up? Why did they miss the target? And usually, by the way, those are followed with court-martials. So that's what should be going on.
Who's going to get court-martial? Who's going to get court-martial, so to speak, Steve?
Well, we've got two governors that I think would go out the window in a hurry in an after-action report. They'd both be court-martialed immediately. With regard to the Fed, you've got Jerome Powell. In regard to the Bank of England, you've got Andrew Bailey. Now, England, there's another little twist in the UK story, and that is you've had two duds as prime ministers. You had Boris Johnson, and Boris Johnson's problem is that he's a big gas bag. He's He's full of hot wind. He had no interest in any details in terms of economic policy. And the worst thing, he was a big warmonger. He got the UK into this war they're in with the Russians. Now that is a big problem because it dents confidence, and of course it puts a big hole in the budget. Liz Truss, of course, was a foreign minister. Then she became the prime minister. She's another big warmonger. And in addition, somewhat like Boris Johnson, she doesn't practice what I call the 5 Ps. Prior preparation prevents poor performance. And as a result, she comes into office. They present this mini budget, was a wacko thing in the first place. That upset the markets. And that's why the Bank of England had to come in and intervene and start buying gilts. The big thing, it had nothing to do with what was going on in the real economy or inflation or anything else. It was the financial markets. The pound took a nosedive and gilts took a nosedive. The pension funds had themselves in a ringer. And the thing that bothers me about this is the way the press has dealt with it. The press is so dishonest, or it could be ignorance too. So either they're ignorant or they're totally dishonest. They started to tar and feather Ronald Reagan and particularly Margaret Thatcher by saying, oh, Liz Truss with this mini budget, she's just trying to do a Thatcher. She's just like Thatcher. No, they got it all wrong. The most famous budget in the history of the United Kingdom was in 1981. It was Margaret Thatcher's budget. I know quite a bit about this because Sir Alan Walters, who was my colleague and collaborator, we did a couple books together and wrote a Forbes column called Point of View for many years together, as well as journal articles, that sort of thing. Now, Sir Alan was who? He was the economic guru for Thatcher. And what was the 1981 budget? The 1981 budget, in contrast to Truss's mini budget, reduced government spending and increased taxes in the middle of a recession. Great Britain was in the middle of a recession, and Guru Walters said, we've got to establish confidence. The budget deficit is way too great, and the only way to establish confidence is to reduce that fiscal deficit, and you do that with a tax increase and a squeeze on government spending. So then what about monetary? They goosed the money supply.
Yeah.
On the recommendation of Walters. And Walters knew, as a good monetarist, he knew that money dominates. Monetary policy dominates. Now, the reason this is so famous, and it's a crime that the journalists can't even pick up on this, and they could Google around and figure the damn thing out in 2 seconds. 364 economists, all the top economists in Great Britain, signed a letter in the Times newspaper of London saying that this mix, this tight squeeze on fiscal policy in the middle of a recession would kill the economy. The recession would grow, it would expand. Of course, they were all Keynesian fiscalists, and that's what a Keynesian fiscalist would say. They forgot the monetary side of the thing and the fact that money dominates. Whatever you're doing on the fiscal side gets swamped by what's going on the monetary side. And so you squeeze the fiscal in 1981 with Thatcher, and you goose the monetary side. And what happened? Right away, confidence came back. The pound sterling had a huge rally almost a day after they announced this budget. And the economy started booming because the money supply cut loose. But this is exactly the opposite of what Truss was doing. And what's the press say? They try to go back and rewrite history and smear the free market ideas of Thatcher and Thatcherism by saying, oh, this is what Truss did with a mini budget was exactly what Thatcher was doing. No, it was exactly the opposite.
Have you ever met Margaret Thatcher, by the way? Just out of curiosity. We'll get back to the actual topic at hand. But I know you worked with Reagan closely, but curious as to whether or not you...
No, I did not, unfortunately, ever meet Margaret Thatcher. But of course, Alan Walters, as I said, he was a professor at Johns Hopkins, where I'm a professor, and we were very close colleagues. And he was at 10 Downing Street calling the economic shots with Thatcher. So I knew intimately what was going on almost day to day at 10 Downing Street, the economic sphere.
Well, bringing it back to the Fed, a lot of people would just like to know from you whether or not the Federal Reserve is going to pivot anytime soon. We hear that word a lot in the press, whether or not you interpret that as meaning pause rate hikes or completely reverse and cut rates. I'll leave it up to you. But when can we see a reversal of hawkish policy is basically my question.
I think the most likely thing that would cause a pivot, a real pivot, would be a crisis in the financial market due to the illiquidity problem that might result from this no growth or negative growth in the money supply. That happened, by the way. They started to do quantitative tightening in several years back. Now the date is escaping me. I think it was 2019. But remember the big problem we had in the repo market. There were a lot of failed trades in the repo market, and that was due to quantitative tightening coming in, and basically the Fed had to pivot immediately because there was really a crisis in the financial engineering aspect of the financial market. So right. if that kind of thing occurred again, I would assume they would pivot. Beyond that, I really have no particular clue on it because they aren't watching the money supply. They don't think the money supply is important and they're not watching it. So as a result, the thing that concerns me is the fact that the money supply isn't growing, but I don't think that's on their dashboard. To make a long story short, the fact that the money supply is not growing, it actually is shrinking a little bit. Probably they might not even be aware of that. So why would that cause them to pivot? It wouldn't. If you're not looking at it, why would you pivot? Because the money supply isn't growing. Well, you would pivot if there was a big liquidity crisis in the financial market. Then they would pivot.
That's exactly it. So basically, to your point about a recession basically being imminent, I mean, 90% is basically a near certainty. They would have to respond to that, right?
Well, they eventually will respond to it, but somehow they think incorrectly that you have to have a hell of a big recession to reduce inflation. This is just utter nonsense. What they should be doing to avoid the recession and let the inflation work out of the system over time is to hit the golden growth rate, watch the money supply, keep it growing at around 5 or 6%. That's the rate consistent with a 2% inflation target. If they did that, we would not be talking about 90% probability of recession. I wouldn't be talking about a recession at all.
Or maybe if we get a major financial crisis or a collapse in the stock market beyond what we've seen. Someone told me this recently, Professor, and I'd like you to comment on it. Somebody told me that the unofficial mandate of the Federal Reserve is to protect the integrity of the financial markets. In other words, maintain financial stability. It's not an official mandate, but it's one of their unofficial mandates aside from unemployment and inflation, which are their two official mandates. What do you think?
Well, that's true to some extent. It's very true of the Bank of England. They say explicitly, by the way, and that's the reason they pivoted, because there was a uproar in the financial markets 2 weeks ago. That's why they pivoted. In the U.S., I think financial markets upheaval in the financial markets, the liquidity crisis, something like that, that rattles the Fed's cage. There's no question about it.
All right.
It isn't an official mandate. They do pay lip service to it, by the way, that they want to keep, financial market stability and so forth, even though it's not written into the Employment Act of 1946, which simply indicates that they should be watching the employment, the labor market, and inflation. But there are a lot of things that are now in the picture. That's one big problem that the Fed has. They have climate change. They're supposed to be the Fed is supposed to be dealing with climate change. Now, what monetary policy has to do with that is, causes you to scratch your head a little bit. Then we have equality issues and gender issues and everything under the sun that actually has nothing to do with monetary policy. I mean, even tangentially, but that's part of how they're being pushed by the politicians in Washington, especially the left-wing politicians.
I can't answer your question as to why the Federal Reserve is engaged in non-monetarist policies like climate change. I suspect, and I jest, of course, but I suspect that if half of New York is underwater, then it wouldn't really matter if rates are 6% or 4%. I don't know.
No, maybe who knows? Maybe they have a big fleet of rescue boats or something.
I don't know. Let's move on. Inflation. It's interesting because so you've outlined your expectations for inflation, 6 to 8% by December. I wonder why headline inflation has been decreasing steadily over the last 4 months, peaking in June, of course, as you know, 9.1%. It's come down to 8.2. The last reading, down from 8.3 the previous month. So not a big change, but, still up there. It's trickling down. But core inflation, Professor, core inflation, stripping out food and energy, that's been trending up. Why is that?
Well, the first thing, the headline inflation, by the way, it's still pretty punishingly high. And that 8.2 number, it was down from 8.3 in August. That's true. But it was actually up relative to the consensus. The consensus was 8.1 and we ended at 8.2. So it was a little stronger than the consensus thought. And one reason for that is that the core inflation number, which excludes food and energy, actually jumped up from 6.3 to 6.6%. I mean, it's reaching new highs. So
yes.
You ask, well, why is the headline coming down a little bit? And it's really mainly because of energy. And energy contributed 1.4 percentage points to that inflation headline number this time, and it contributed 1.7 percentage points in August, the month before. So the contribution of energy to the headline number it backed off a little bit, and that drug it down. Mm-hmm. Shelter, by the way, we talked about this before we started the program. Shelter housing jumped up from 6.2% to 6.6%. The big story is that the core services CPI jumped a lot, from 6.1 to 6.7%, but the core goods actually went down a lot, from 7.1 to 6.6%. Now, what's going on is a shift. The initial surge lifting in an important thrust in the inflation thing was the price of goods going up. And that's logical because a lot of the time we were actually locked down. So if you wanted to get a haircut, that's a service. The barbershop was closed. I know you got a haircut. I can remember that, but I don't even know where you got it. I think you got it in Vancouver, as I recall. But in any case, who knows? Maybe your mother gave you your haircut.
I haven't let my mother touch my hair since I was 12. I've learned from that experience. She cut my hair
Okay.
and my ear, and I've learned to consult a professional. Professor, the last thing I want to consult you on, because you are a professional economist. Okay, sorry, I'll let you finish.
Just the main message is inflation's still elevated. It's come off a little bit, mainly because energy's come down a little bit. And there's been this big shift from the thrust of what's lifting things is obviously the money supply. That's the main thing. But what's driving it are price increases now in services more than goods. Goods are settling down a little bit. They're still very high, by the way. So they're actually about the same. The goods price for core is 6.6, and the service price for core is 6.7. So they're both about the same, but they're switching around, and so we can anticipate more price increases for going out to restaurants, getting your hair cut, all of the service activities.
Well, you've certainly given us a lot to contemplate, Professor. Final question, I'll let you go. I want to talk about the housing market. You did bring up housing when you discussed inflation, because housing is a big component of the CPI index. The Case-Shiller price index, Professor, that's been trickling down. It's peaked a few months ago, and it's been coming down. Now, it hasn't crashed to the same level as 2008 yet. Of course, if you take a look at this chart, it's lagging by a few months, of course. But, even then, is this a concern for you, this downward spiral that we're potentially seeing right now?
Well, it isn't a concern; it's a fact, and it's related to the recession that I think's baked in the cake, with over a 90% probability of occurring in 2023. Usually, housing, by the way, it is usually a leading indicator of. It's a very important big sector, and real estate is a leading indicator with regard to recession. So that looks like it's just lining up for what I anticipate a pretty good recession in 2023.
If you go back to the chart, please, let's take a look at the chart, Professor. You'll notice that following 2008, when it troughed around 2011, the housing market, according to the Case-Shiller index, did not return to its pre-2007 or 2008 level until 10 years later. That's a heck of a long period of stagnation, Professor.
Yeah,
is that going to happen this time?
No, because what happened the last time? Number one, there was a lot of turmoil. It was very concentrated in the housing sector because of securitized mortgages and the financial aspects of the housing were all tied up with 2008. But the reason it didn't come back very fast was the money supply. We had, remember, after Lehman went down and we had these problems with securitized mortgages, Washington, D.C. concluded that the bankers were bad people, banks were bad, you got to regulate them more. Dodd-Frank legislation came in, squeezed the banks tremendously because the banks have been engaged in issuing securitized mortgages. So as a result of that, the bank's contribution to the money supply went south. It went negative. To compensate for that, the Fed did quantitative easing 1, 2, and 3, fortunately, because if they hadn't, since the banks were contracting their contribution, we would have had a money supply that was contracting, and we would have had a tremendous depression, actually. As it turned out, thanks to quantitative easing 1, 2, and 3, the money supply did grow, but not very fast. It only grew at about 4.5%, 5.5% during that period. And that's why housing and the economy never really came back very fast. And that's also why we never had much inflation. the money supply was growing actually below the golden growth rate, consistent with an inflation target of 2%. And most people just don't understand 2008. Most people say, oh, people who look at the money supply, they don't know what they're talking about. They did quantitative easing, a huge expansion of the Fed's balance sheet. We should have had a huge inflation as a result of that. But we didn't have inflation. They couldn't even get the inflation rate up to 2%, which was a target. Well, that's because they were only looking at the Fed's contribution. They weren't looking at the contribution of the commercial banks, which actually is the most important part. And if you add them both together, what did you end up with? A net number that was pretty slow growth in the quantity of money measured by M2. And that's why it took a long time for us to get out of the recession in 2008, by the way. And that's why that's one reason housing was very slow coming back. Another reason is there had been a tremendous financial disruption in the housing market. It was way over leveraged in 2008 and was a big contributor to the crisis and so forth.
Well, Professor, I think we're just about out of time, but I'll finish up on your gold sentiment.
You want to talk about gold? You want to talk about the Hanke Gold Sentiment Index?
Yes. Let's talk about I was just getting to that, the Hanke Gold Sentiment Index, a very good indicator for where the gold price is going. Give us your latest update, Professor.
Okay. It's a very good indicator for the short-term moves and changes in sentiment in the market. This is like putting a doctor putting a thermometer in your mouth or someplace else and measuring your temperature. And it tells you short-term changes in sentiment. We measure that by doing what we call text mining. We look at the articles that have come out every hour that relate to gold and whether they're bearish or bullish. And that gives us a sentiment. And trading off of those on a fairly high frequency basis over the last year, we're up about 70%. So sentiment, if you can read sentiment, you can trade sentiment, and it looks to us like the proof of the pudding is in the eating. It's pretty good. 70% over the last year is not bad.
All right. Well, we'll put the link to the sentiment indicator in the description below. People can click on it and check it out in more detail. And I believe there is a paid service to this, right, Professor? If you get live updates.
Well, right. It starts with a kind of a minimalist. If you want to put your toe in the water, you can have a free subscription. And if you want to have more and more data, you of course go deeper and deeper in the water, and that requires a small fee.
All right, thank you, Professor. Enlightening talk as always. I learned a lot, and I hope the audience will as well. We'll speak to you again next time soon. CPI data is coming out again in a few weeks. Thank you, Professor, and thank you for watching Kitco News. I'm David Lin.